Our session is on capital expenditure analysis. Here we take the financial math we've developed in the last several sessions and begin to see how it is applied in project evaluation or project investment analysis. We cover 4 topics, which are actually the 4 steps, the 4 principal steps in capital expenditure analysis. The first step is to characterize the project. The second is to estimate the project's cash flows. The third step is to determine the discount rate. And the fourth step is to calculate the net present value. The first step is to characterize the project by asking a few key questions. The first question is whether the project involves new business or no new business. That is, does the project generate cash inflows from new revenues, new programs, and new business lines? Or does the project focus on cost reductions and technological change and therefore no cash inflows? A second question is whether the project can be evaluated as an independent standalone decision or whether we're considering 2 or more projects that are mutually exclusive and we must select among them. And the third question is whether there is some artificial constraint on the amount of money that's available for investments this year. Now note that there's always a natural constraint that's imposed by the financial markets that shows up as how much money the firm is going to be able to raise for investments in this time period on good terms. Step 2 is to estimate the cash flows associated with the project. Specifically, we want to estimate the expected net cash flow in each time period, where net cash flow is the difference between cash inflows and cash outflows in each year. Now we're going to want to start with our best estimate or most likely estimate of all of the components of cash inflow and all of the components of cash outflow. We might think of the components of cash inflow as volume of sales, price at which we can sell our goods and services, and for those cash inflow determinants, what we want to do is to estimate as well as we can our most likely set of prices and our most likely volume of sales. For cash outflow, we want to know our cost function, which is defined by our fixed costs and our average variable costs times the volume of sales again. So what we need here is our best estimate of what our fixed costs are going to be, as well as our best estimate of what our average variable cost will be per unit of sales produced. Importantly, some of our expense items are non-cash items or non-cash flow items, and we're going to need to exclude those when we move from expenses to cash outflows. We want to measure all of our cash flow components on an incremental basis. That is, what we want to identify are the cash inflow and cash outflow components that are there if we adopt the project, but that won't be there if we do not proceed with the project. In identifying incremental cash inflows and cash outflows, all of the rules of differential cost accounting apply. So if you've had a cost accounting course, you know what these rules are, and I've got a list, or at least a partial list, of some of these rules here. Number 1, when you're determining incremental costs, you want to forget about sunk costs. So for example, let's say that we're considering a new business that will occupy land that we purchased 5 years ago for $2 million. The amount that we spent on that land 5 years ago is a sunk cost. It is irrelevant to the decision about whether to go forward with this new business opportunity. What is relevant is the amount of money that we could raise if we sold the land right now, which gets us to our second rule of differential cost accounting. And that is to use the opportunity cost of an asset or a resource as a measurement concept. So using our land example, if we can sell the land now for $3 million, and that's the best alternative opportunity for using that land, then the true or differential cost associated with using the land in this new business is $3 million. Rule 3 is to include working capital or cash and other current asset requirements of the new business opportunity. So if the new business opportunity requires that we add cash or accounts receivable or inventory to our balance sheet, that is an incremental cost that we need to reflect in our cash outflow analysis. Rule 4 is to include incidental costs or effects on other business lines of the project in question. So for example, if the project in question steals business from some other business line of our company, we need to reflect that effect as an incidental effect in our cash flow analysis. Finally, Rule 5 is to beware of allocated overhead. Let's say that our new business is going to be using management resources that already exist in our firm. If we're already paying the salaries of these managers and we're just asking the managers to oversee this new business line, and we thereby allocate some of their time as a cost to this new business, that would be allocated overhead. And if that allocated overhead is truly not differential, that is, does not involve additional salaries and wages expense, it's irrelevant and should not be included as a cash flow component. Step 3 is to determine the discount rate to apply. Discount rate determination is highly complex, and we're going to be spending a lot of time in the course in determining the appropriate discount rate to use to evaluate specific projects. For now, I'd like to introduce some basic principles of discount rate determination. First, the rule in terms of setting your discount rate is to use the cost of financing or rate of return imposed by the investors in the project. The process in coming up with the discount rate is to start with the overall financial structure of the firm and calculate the weighted average cost of capital, which will be our discount rate, or at least the starting point for our discount rate. Now, the weighted average cost of capital is equal to the weighted average of the cost of debt and the cost of equity. So we think of the investors in the project as debt suppliers and equity suppliers. Debt suppliers lend us money and charge us an interest rate. Equity suppliers purchase our stock and have a required return on equity that they expect. Now, what we want to do is to take the average of the cost of debt and the cost of equity, weighted by, where each is weighted by the percentage of our assets that are financed by debt or equity. So the weight for the cost of debt is debt divided by debt plus equity, or debt divided by assets. And the weight for the cost of equity is equity divided by debt plus equity, or equity divided by assets. Here's an example of a weighted average cost of capital calculation. Let's say the lenders are willing to lend us money at an interest rate of 3.2%. Let's further say that the required return on equity is 7%. If we have $60 million in debt financing for our firm and $40 million in equity financing for our firm, we have a total of $100 million in assets. then the weighted average cost of capital is equal to our 3.2% times 0.6 plus our 7% times 0.4 for a weighted average cost of capital of 4.72%. And that could be a starting point for the determination of our discount rate. If a project generates a positive NPV with a discount rate of 4.72%, that project generates enough cash to pay its debt service at 3.2% and to grow equity at least 7% per year, and in fact generates an additional amount that's equal to the value of the net present value calculated. Regarding inflation, we want to remember the key rule of inflation in these capital expenditure analyses, which is as follows. We need to be consistent with how we handle inflation. So we have a couple of choices. We can use nominal interest rates to discount nominal cash flows. That is, if the cash flows reflect an inflationary process, our interest rates or discount rates ought to be inclusive of inflation as well. Or we can use real interest rates to discount real cash flows. So if in our analysis we measure our cash flows free of inflation, then we should use inflation-free interest rates or discount rates. And we should get the same results depending on whether we use nominal or real figures. We'll come up with some examples of the effects of inflation in the various financial analyses a bit later in the course. Now let's apply the investment decision analytic model that we've been developing to IM&C's guano project that's in Chapter 6 of the Brealey and Myers and Allen text. What we have here is the summary of the NPV calculation for the guano project. Let's see how we arrive at an NPV of $3.52 million for the guano project. Here I've created a worksheet to demonstrate the calculation of the net present value of the IM&C guano project based on the identification of the project's cash flows. The worksheet is entitled IM&C's Guano Project Pro Forma Income Statement and Balance Sheet to Net Cash Flow. And the short name for the worksheet is Guano Jack. This worksheet is a reconfiguration of the tables as presented in the Brealey, Myers, and Allen text. It uses the cash flow analysis structure that we shall employ for the rest of the course and which reflects common financial analysis practice. You will notice that the structure differs in several ways from that which we have used up to now. First, the spreadsheet has been rotated 90 degrees so that the year or period is now indicated in columns. And the cash flow components are now presented in rows. This format allows for the clear presentation of a pro forma project income statement as the starting point for determining the net cash flows in each year. The pro forma income statement is presented here in this central part of the worksheet, and the relevant numbers for the income statement are highlighted here in maize. This structure also allows for the clear identification of cash effects resulting from changes in balance sheet accounts. And you can see the balance sheet cash effects are presented here toward the bottom of the worksheet, and the relevant numbers are highlighted in blue. The starting point in projecting the cash flow of a project is the development of a pro forma or projected operating statement or income statement. Presented here is a simplified version of a project income statement. The top line of the projected income statement is sales or revenue. Projected sales will depend on both volume and price. As you can see, revenues for this project are expected to grow rapidly through year 4 and then to diminish. This pattern of revenue over time is reflective of growing and then decreasing volume. The next 2 rows of the projected or pro forma income statement show cash costs for such production inputs as materials and labor. Revenues minus cash costs yields EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. EBITDA is the operating cash generated by the project. Next, we subtract depreciation expense. Recall that depreciation expense is a non-cash expense. As such, depreciation expense never generates a cash outflow. However, we need to account for depreciation expense here because it creates a tax shield or a tax deduction which lowers the project income tax bill. Subtracting depreciation expense from EBITDA gives us pre-tax profit, sometimes called EBIT, which stands for earnings before interest and taxes. Then we calculate the taxes associated with the project profits. And finally, we calculate the profit after taxes, which is sometimes called EBIAT, which stands for earnings before interest and after taxes. Let's look at the pro forma income statement for project year 3. In year 3, we have projected that sales or revenue are going to be $32 million. Cash costs are going to amount to somewhat over $20 million, leaving us with about a $12 million earnings before interest, taxes, depreciation, and amortization. Depreciation expense, calculated on a straight line basis, is going to be $1.5 million per year, giving us a pre-tax profit or EBIT of about $10 million. The tax bill is going to be about $3.5 million, leaving us with a projected profit after taxes or EBIAT of about $6.6 million. This $6.6 million in earnings before interest and after taxes is the cash flow of the project resulting from changes in the income statement accounts. But we haven't yet gotten to the net cash flow of the project. For that, we have to consider changes in cash due to changes in balance sheet accounts. There are 3 common balance sheet account effects on cash that must be considered in arriving at net cash flow. And they are, first, to add back the depreciation expense which we subtracted up here in the income statement in order to arrive at our profit after taxes. Because depreciation expense is a non-cash expense, it must be added back into EBIAT to arrive at net cash flow. Second, if the project requires any change in a current asset account, such as inventory or cash, that change in a current asset account, positive or negative, must be reflected in determining net cash flow. And third, the project will typically require a capital expenditure. And so we have the capital investment shown here as $10 million in year 0. And down here the capital expenditure is shown as a cash outflow of $10 million on a balance sheet account in year 0. So to summarize the changes in the balance sheet that affect the cash position of the organization and therefore affect the net cash flow of the project, there are three. The first is the recognition that depreciation expense is a non-cash expense, and hence we need to add that expense back in determining net cash flow. The second is to identify any changes in working capital, such as inventory or cash, that is current asset accounts, that result from the establishment of the project. And the third is to reflect the capital expenditure or the increase in any fixed assets that are going to be required for the project. Once we've projected the income of the project after taxes, and we've adjusted for the changes in cash that would occur on the balance sheet, we arrive at the net cash flow for the project in each year. So our net cash flow is presented here on this line, and we see that in year 0 we have a net cash flow of minus $12.6 million, and we have a negative also in year 1, but then positive cash flows in years 2 through 7. The final step in the capital expenditure analysis process is to calculate the net present value. As a review, let's just go through the calculation of the NPV based on the cash flows we've developed. So I'm going to delete this NPV calculation, and I'm going to go up to the top and invoke the NPV function. The example in the book has the company with a discount rate of 20%. So I'm going to put 0.2 in as our rate. The cash flow values are the values or the cash flows for years 1 through 7. I'm going to say OK, and then remember we have to go up to the formula bar and amend the NPV function by adding back in the year 0 cash flow, and there's our net present value for the guano project. The project generates an NPV of about $3.5 million. We would interpret this result as indicating that the project increases the value of the IM&C firm Another interpretation is that the project generates enough cash to cover its operating costs, which are reflected here in the operating statement, to cover its financing costs, which are reflected in the 2% discount rate, and to add additional value to the firm. And the additional value that it adds is this $3.5 million. The effect on IM&C's stock price associated with adopting this project would be given by dividing the net present value of $3.5 million by the number of shares outstanding. So, for example, if there are 1 million shares outstanding and we have a $3.5 million project, the stock price ought to rise by $3.50 if the company decides to proceed with this project. So we see here an important link between the search for positive net present value projects or new business lines and the stock price of the organization or the firm. When the firm can identify positive NPV projects, it will be able to increase its stock price. Before concluding this session, I want to make 2 additional points that are important for setting up a capital expenditure analysis or investment decision analysis properly. The first one is to note that the pro forma or projected income statement is made without reflecting interest expense as a cash flow. Interest expense is a component of the overall cost of financing, and financing costs are reflected in the discount rate. So we never want to reflect interest expense in determining the net cash flow of the project. The second concluding point here is that the cash flows, especially the income statement components of the cash flows, have been projected in nominal terms. So our discount rate of 20% was a nominal discount rate reflective of inflation as perceived by the suppliers of debt and equity capital. Likewise, our cash flow projections are reflective of inflation as expected out over the life of the project. By projecting our cash flows in nominal terms and using a nominal discount rate, we've been consistent in our treatment of inflation.